In April 2026, the Justice Department announced a compensation process for victims of OneCoin. More than $4 billion had gone into the purported cryptocurrency. DOJ said more than $40 million in forfeited assets was currently available for victims. That enormous gap is the ending. The beginning is even stranger. The woman the FBI says led OneCoin is still on its 10 most wanted list. The current reward is up to $5 million. But the most important evidence is not the disappearance. It is what millions of buyers had actually purchased. DOJ says OneCoin lacked a true blockchain, a public, independently verifiable ledger. And the company's own internal spreadsheets, according to DOJ, separated mined coins, real, from fake coins. So how did real money become a digital balance that buyers could not verify? And how did that contradiction grow into a global machine? OneCoin did not begin by selling coins on an open exchange. It sold educational packages through a multi-level marketing network. Packages included tokens. Those tokens were presented as a route into OneCoin's supposed mining process. Members could earn commissions by recruiting more package buyers. The mining story supplied a familiar piece of cryptocurrency theater. DOJ says promotional materials depicted mining pools as computer hardware. But there were no mining pools and no computers mining OneCoin. In emails described by prosecutors, Greenwood and Ignatova discussed whether a member could discover that the process was only software, rather than investment in mining machines. The operation did not merely hide a technical detail. It used the language and imagery of real crypto infrastructure to make an internal allocation system look independently earned. That structure solved the scheme's first problem: distribution. Every buyer could become a salesperson. A product pitch could arrive through a friend, relative, or community leader rather than a cold advertisement. The second problem was price. Legitimate crypto markets can be chaotic because buyers and sellers continually disagree. OneCoin's displayed value moved in a much more convenient direction. DOJ says the company itself arbitrarily set the price, without regard to market forces. The purported value rose from 50 euro cents to about 29 euros and 95 cents by January 2019. It never displayed the kind of decline an open market would normally allow. The number on the screen looked like a price, but there was no independent market discovering it. That gives us a simple verification test. Could a buyer compare the displayed price against an independent order book? Could an outside custodian confirm the coins? Could anyone inspect a transaction history that OneCoin did not control? According to DOJ's account, the answer was no. The same organization supplied the coin, the conversion story, the ledger, and the price. A steadily rising number was therefore not outside evidence of demand. It was another claim from the seller. Then comes the ledger. A public blockchain is not a guarantee that an investment is honest, but it does give outsiders a way to inspect transactions and supply. DOJ says OneCoin claimed to have a private blockchain while lacking a true public and verifiable one. Buyers therefore had to trust the same organization that issued the balances, controlled the records, and set the displayed value. By approximately March 2015, DOJ says OneCoin's founders had begun allocating members' coins that did not exist even on the purported private blockchain. The internal term was brutally direct: fake coins. DOJ later described spreadsheets with separate lines for mined coins marked real, and fake coins. This visualization is a reconstruction of that official description, not a recovered OneCoin spreadsheet. The contradiction was not theoretical. DOJ says an August 2015 email discussed the implication of 1.3 billion fake coins. The system was recording a scale problem inside its own vocabulary while the sales network kept expanding. Here is the mechanism in one line. Real money entered OneCoin-controlled accounts. Buyers received packages and tokens. The company controlled the token conversion, the ledger, and the displayed coin value. Recruiting commissions encouraged the network to bring in the next buyer. The appearance of growth could therefore reinforce the sales story without an independent market confirming the asset underneath it. The numbers became enormous. DOJ says that between the fourth quarter of 2014 and the fourth quarter of 2016, The scheme took in more than $4 billion from at least 3.5 million victims. Carl Sebastian Greenwood, OneCoin's co-founder and global master distributor, earned 5% of monthly sales worldwide and more than $300 million in total, according to DOJ. DOJ's sentencing release also traces what some of that money purchased: approximately $2 million in designer clothing, footwear, and watches, a large down payment on a yacht, properties in several countries, luxury travel, and promotion aboard a private OneCoin airplane. Those details matter less as spectacle than as a ledger entry. The commissions were paid in real currency, while the buyer's supposed wealth remained inside a system the company itself controlled. Greenwood was arrested in Thailand in 2018, extradited to the United States, and ultimately sentenced to 20 years in prison. He was also ordered to pay approximately $300 million in forfeiture. Ruja Ignatova's story has a different legal status. She is charged, wanted, and remains at large, not convicted in the United States. The FBI says she was charged on October 12, 2017. 13 days later, she flew from Sofia, Bulgaria, to Athens, Greece. She has not been seen publicly since. The current FBI poster says OneCoin is believed to have defrauded victims of more than $4 billion. It offers up to $5 million for information leading to Ignatova's arrest or conviction. Then, in April 2026, DOJ announced the remission process. More than $40 million in forfeited assets was currently available for compensation. That is real recovery. It is also a small fraction of the more than $4 billion DOJ says victims invested. The announcement did not call $40 million the final total, so neither will we. It does show the scale of the gap between money entering a fraud and money authorities can later trace, seize, and return. Using only those headline minimums, the amount currently available at the announcement was roughly 1 cent for every dollar invested. That is not a final recovery rate, and individual outcomes may differ. It is a scale comparison. Billions moved quickly into the scheme, while recovery depends on locating, forfeiting, and legally returning specific assets years later. That is the lesson hidden inside OneCoin's impossible ledger. The warning was not simply that a cryptocurrency can be fake. It was that every important number came from the same side of the transaction: supply, mining, price, balance, and the rules for converting or cashing out. When no independent system can challenge the issuer's numbers, a rising balance can be a sales prop rather than evidence of value. If you want the document before the drama, subscribe to the Con Ledger. We follow the money through the official record, and the next case begins with a company that said nearly €2 billion sat in bank accounts until the bank said otherwise.